On Friday, August 15th, Vladimir Putin and Donald Trump met at Alaska to discuss a possible ceasefire between Ukraine and Russia. Their arrival was dramatic. Both leaders stepped off their plane and greeted each other and walked towards the stage. As they walked, a B-2 bomber accompanied by 4 F-35 fighter jets flew overhead. It's the same type of aircraft that just carried out strikes on Iranian nuclear facilities. It's a show of strength, signaling Trump's attempt to put pressure on Putin ahead of the talks. However, the meeting's outcome appears to be inconclusive. No peace deals were reached. Instead, it appeared to serve primarily as a chance for Putin to lay out his demand and conditions directly in person to Trump as a basis for any potential peace deal in the future. Following the discussion, Trump informed the Ukrainian president and European leaders in a call that Putin asked Ukraine to cede all of Donetsk. In exchange, Russia would freeze most of the front lines, meaning Russia would stop pushing or advancing. Putin emphasized that achieving peace depends on tackling the conflict's root causes, which he framed as NATO's eastward expansion. So meaning that he doesn't want Ukraine to ever be able to or ever be allowed to join NATO. European leaders and European Union later issued a statement outlining their key demands. One of them is security guarantee. Ukraine must provide with firm and binding security assurance without limitation on its military capabilities or foreign assurance, meaning that Ukraine must be allowed to join NATO. Number two is sovereignty. So territorial decisions must remain the sole right of Ukraine, with borders not subject to alteration by force. Number three is Western support. So the US and Europe reaffirmed their commitment to continue military and economic assistance while maintaining sanctions on Russia until fair and lasting peace is secured. So I feel like it seems pretty clear to me that major gaps remain between the two sides, and Russia is demanding territorial concession from Ukraine and assurance that Ukraine will never be able to join NATO. In contrast, the European Union and European leaders insists that Russia must return occupied land back to Ukraine and that Ukraine must receive binding security guarantees, which would most likely involve joining NATO. So while the gap between the two sides' positions are significant, I think the outcomes are hard to predict. To me, there is roughly a 50-50 chance of reaching a peace deal in the near future, most likely less than a year, because Donald Trump is really focused on getting this fixed. What must also be considered are the implications for the financial market. The defense sector stands out, since the valuation of the defense sector is closely tied to the continuation of the war. A substantial share of the U.S. weapons and military equipment exports are currently directed towards supporting Ukraine. Since the beginning of Trump's second term, NATO has been buying U.S. weapons, and they buy it and gift it or send it to Ukraine. Right? So any progress towards peace would have a significant impact on U.S. Defense industry performance. The largest U.S. aerospace and defense ETF is the iShares U.S. Aerospace and Defense ETF, ticker symbol ITA. Currently have asset under management of $7.8 billion, even though its price is at near all-time high, but we're seeing a sign of momentum loss, and there appears to be a peak on July 30th. Another sector that's likely to be significantly influenced by a potential peace deal is the oil and gas sector. If an agreement is reached, it could lead to the easing of sanctions on Russian oils and Russian energies, which would increase the supply of global energy and will put downward pressure on the oil price. So XLE is the ETF that we watch for energy sector. It represents the energy sector within S&P 500. The ETF hasn't done much in the past 3 years. It's just fluctuating sideways. So I think if a peace deal is reached, it's not only going to hurt the American energy companies' margin because they depend on the commodity price to make money, and it's also going to help cool off the inflation, which is aligned with Trump's objective and which also gives Federal Reserve additional justifications to further cut interest rate. This is what I want to highlight at the sector level. Let's talk about inflation and Federal Reserve. In the past few trading days, the hottest topic in the market has been stagflation. While the July CPI numbers came in largely as expected, the PPI wasn't that great, right? So this chart shows you the CPI for July, month over month up 0.2%, same as expected. Core CPI month over month up 0.3%, in line with estimation. The year over year CPI a little bit cooler at 2.7%, cooler than expected 2.8%. Core CPI year over year up 3.1%, slightly above the 3%. Right? So CPI is not the problem. The problem is the July producer price index, PPI. It's painting a different picture. The headline PPI month over month up 0.9%, far above the expected plus 0.2%, marking it the largest increase since June of 2022. And on a yearly basis, which is represented by this blue line, PPI rose 3.3%. It's the highest level since beginning of this year, February 2025. So combining this strong or hot PPI with the weaker than reported non-farm payroll data, right? Remember, on July non-farm payroll, they revised the June and May data downwards by a lot, right? Meaning that the job market has been cooler than expected, right? A hot inflation plus a cooler than expected job market, it's painting a stagflation picture. The mainstream media widely attribute this hot PPI report to the impact of tariff. However, some right-leaning commentators argue that if we look at final demand goods, the core, right, less food and energy, it's only up 0.4% instead of 0.9%, suggesting tariffs' effect on PPI is limited. However, I personally think this view is very questionable because even though energy is not tariffed, but many food imports into the U.S. are tariffed. Okay, so excluding food and energy, this 0.4 doesn't tell us anything in this context, because if you look at the food, right, food is up 1.4% compared to a month ago. That's way above 0.9, right? So food is playing a big role on pushing this PPI up. Trump's most popular advisor, Peter Navarro, who is the architect behind the tariff policies, also made a comment on the PPI numbers, reflecting his perspective on the data.
What you want to see is whether the PPI numbers will move to the CPI, the Consumer Price Index, which is not always the case at all. We also know that the PPI is highly volatile. We also know there's going to be some people who are going to try to make it a tariff story, but if you peer beneath the hood of the numbers, there's nothing in there to suggest that tariffs were responsible for a number that was above estimates. So this is clearly a case where you just watch the data now, and you watch it really carefully. And as the boss says, let's see what happens.
Since he's the man behind the tariff policy, there's no surprise he would downplay the PPI surge. But the more important point, however, is whether the rise in this PPI report will feed into consumer price, because PPI often acts as a leading indicator for CPI, because PPI is producer price index. It's what the producers see in terms of inflation. It usually takes a month or two to pass down to the consumers. But there's also a chance that this spike could just be a temporary noise. So it's hard to get a clear picture based on one report. Some people argue that tariff-driven inflation is essentially man-made, and it's a policy-driven shock. If tariffs do push the prices higher, the effect will mostly only last for 1 year, because inflation reflects year-over-year change unless the tariffs are increasing further. Let's say the tariff is applied today. A year from now, the inflation would be increasing due to tariff, but 2 years, right? 2 years down the line, compared to the year prior, it wouldn't have any change because your tariff is not increasing. So to determine whether this one, what we are seeing right now, is a true beginning of stagflation, the key will be to monitor future CPI releases, which will show whether this PPI spike will translate into a sustained consumer inflation or not. According to CME FedWatch tool, the futures market is now pricing in a 92% probability of a 0.25% rate cut in the upcoming September FOMC meeting on the 17th. So there's still a long way to go from where Trump and the administration wants it to be, but it's moving in that direction.
The rates are too constrictive. If you look at any model, that we should probably be 150, 175 basis points lower.
Beyond inflation and monetary policy, another major worry now is the government's credibility. The recent firing of the BLS Commissioner Erica McIntyre, according to Donald Trump, is due to significant downward revision to the latest July non-farm payroll report. In that report, the May non-farm payroll was revised down by 125,000, and June was revised down by 133,000 jobs. This has fueled headlines in mainstream media questioning whether U.S. economic data can still be trusted with the newly appointed commissioner. Critics argue that the move undermines the independence of Bureau of Labor Statistics. Many observers believe that the new BLS commissioner will be forced to manipulate data if another major revision occurs, since the previous commissioner was removed over large revisions. However, that doesn't necessarily have to be the case, because the cause of the large revisions is the decline in initial data collection rate, which is represented by the black line. There is a downtrend for many years, right? So this is the percentage of survey that are returned back to BLS late, okay? The more surveys are late, the less surveys will be included in the initial report. And more surveys that come in late, the higher the probability that the revision will be large. So the new commissioner could address this not by altering the data or manipulating the data, but by fixing the data collection method or process. For example, imposing a stricter deadline for when the survey must be submitted to ensure that the initial report would be much more accurate than what we have right now. Another important point is that the Bureau of Labor Statistics, BLS, is here in this chart, is actually operating under the Department of Labor. The Department of Labor is under the executive branch, which means BLS is not an independent agency. It is ultimately under the presidential authority. So from a legal standpoint, this gives Trump the right to exercise full control over the bureau, including removing the officials from that bureau for what he views as a poor performance. So in that sense, even though it's unusual for a president to fire someone before finishing the 4-year term, but it's completely legal. So I don't think it undermines the government credibility, right? I think it's falling within his legitimate power as head of the executive branch. Thank you very much. Please like and subscribe.